Hello, my name is Thomas Akers. This is my database research project for accounting 311, section 1, 1130 to 1245. So the type of industry that I'll be focusing on during this presentation is the film industry aspect for my three different companies. So a brief overview of how my project is I took the history of my three companies, which are Walt Disney, Paramount, and Time Warner, and the respective products that were made by each company. I will also be going over the financial ratios of all three companies, which include liquidity, activity, profitability, and coverage ratios. So the history of Walt Disney Company is the company first started out as being named Disney Brothers Cartoon Studio that started on October 16th, 1923, and was founded by Walt Disney and his brother Roy, with the creation of Mickey Mouse in 1928 and several other iconic characters in that group. This helped him branch out to many other types of film instead of solely being on animation. During the 1980s, Disney began to acquire many other companies' products to expand its influence and market. Once Bob Iger took over the CEO role from Eisner in 2005, that is when Disney began to take over many companies to become its parent company. In 2006, they acquired Pixar and started to focus on digital animation. And under the Disney umbrella, they have many movies such as Moana and Coco that have earned prestigious awards. And in 2009, Disney acquired Marvel Entertainment, which gave them rights to many characters from Marvel. Although they had the rights to Marvel, many characters were still not their property to make as films such as Spider-Man and the X-Men franchise, which are both owned respectively by Sony and Fox. And in late 2012, Disney began to acquire Lucasfilms, which is the studio responsible for the big franchise Star Wars. And in 2019, Disney launched its very own streaming service called Disney Plus, which works very similarly to Netflix and Hulu. So some products under Walt Disney as of now are all of the movies and shows that are in the MCU, including Iron Man, Thor, Loki, etc. The Star Wars franchise movies and shows, including Revenge of the Sith, Empire Strikes Back, The Mandalorian, etc., and the Indiana Jones movie franchise. So with this picture on the left of Indiana Jones is from the movie Raiders of the Ark, which is one of my all-time favorite movies. The picture in the middle is of one from the newer trilogy of the Star Wars movies. However, my favorite movie from those is Revenge of the Sith. And the picture on the right is of Spider-Man, who is one of my favorite comic book characters. So the history of Paramount is Paramount Pictures Corp was established by W.W. Hawkinson as a film distributor. And the first iteration of names, it was called Famous Players Film Company. And by 1927, the name of the studio was changed to Paramount Famous Lasky Corporation with a merger. They became bankrupt in 1933 after suffering losses from the transition to sound in theaters, because beforehand it used to just be moving pictures with no sound. And after beginning to have a monopoly over the film industry, there was a Supreme Court case called United States versus Paramount Pictures, Inc., established in 1948, which stated that it banned movie studios from owning movie theaters. This then resulted in Paramount splitting up into two different companies, one for film distribution and one for theater exhibition. So some products that are under Paramount include The Big Short, Titanic, the Transformers movie and TV show franchise, Mission Impossible movie franchise, and Paramount Plus, which is a new streaming service that works very similarly as Disney Plus, Netflix, Hulu, and HBO Max. So the history of Time Warner includes Warner Brothers acquires DC Comics in 1969 and establishes the rights to them. Time Warner was originally established as Warner Communications by Steve Ross in 1972, with Time Warner being created in 1990 after a merger with Timing and Warner Communications. And on October 22nd, 2016, ACCT required Time Warner for $85.4 billion. So some products under Time Warner include the DCEU characters for their respective movies and TV shows, the Teenage Mutant Ninja Turtles, the Harry Potter movie franchise, Lord of the Rings movie franchise, the Hobbit movie franchise, and another streaming service called HBO Max. So now we'll be getting into the liquidity ratios that will be comparing with all three different companies. So starting off with the current ratio, it is a measure of a company's short-term debt paying ability. And the higher the result, the stronger the financial position of the company. It is also useful for considering which stocks to buy. And a current ratio less than 1 means the company may run out of money within the year. So as you can see with the graph, Time Warner in 2010 was the strongest financial wise among the three different companies. However, from 2010 to 2012, they experienced a decrease. And in 2012 to 2013, they see an increase. And then from 2014, or excuse me, from 2013 to 2014, they experienced a decrease where they are just a little under from where they started in 2010. And if you look at Paramount and Disney, they both seem to have an inverse of one another. However, from 2011 to 2012, Paramount saw an increase in their current ratio, whereas Disney saw a decrease in their current ratio. So the next ratio we'll be looking at is a quick ratio, which measures the immediate short-term liquidity. And a quick ratio of 1 is considered good, and it means that the company has enough money on hand to pay its obligations. A ratio higher than 1 means a company has more money than it needs, and investors become concerned with a quick ratio less than 1 because this means that the company owes more money in short-term liabilities than it has in cash. So as you can see, all three companies are below the 1 ratio. However, Time Warner's from 2010 to 2013 continually decreases at, I would say, a pretty quick rate. However, from 2013 to 2014, they saw an increase in their quick ratio. And once again, Paramount and Disney seem to be an inverse from one another, whereas Paramount from 2011 to 2012 sees a minor increase, excuse me. And with Disney from 2010 to 2012, they seem to be mellowed out. So the next ratio we'll be going over is the current cash debt coverage, which measures a company's ability to pay off its current liabilities in a given year from its operations. And with this ratio, it should be compared with historical ratios with the same company or industry. And even if it is not a 1-to-1 ratio, it's still favorable because it shows a company's ability to repay loans is above average. So with this graph, it shows that Disney is climbing towards the 1-to-1 ratio, which shows that they were getting better at paying, paying their loans. However, from 2013 to 2014, they saw another decrease, and Paramount saw a consistent increase in their ability to repay loans from 2010 to 2013, but from 2013 to 2014, they experienced a major dip. And with Time Warner, from 2010 to 2012, they experienced a decrease. However, from 2012 to 2014, they saw an increase that matched up with Paramount. However, with their decrease from 2013 to 2014, it wasn't as big as Paramount's was. So now we'll be going over activity ratio and starting off with asset turnover. So with asset turnover, it means how a company measures how efficiently assets are used to generate sales. So with the asset turnover ratio, the higher that it is, the better the company is performing. And it's really only helpful comparing with other companies that are in the same industry, which is perfect for this project because you get to compare these ratios with 3 companies that are in the same industry or field. And this ratio is subjective, however, because it depends on the industry that the company is in. So with this graph, you can see that Time Warner is the lowest out of all of them, but they almost are the most consistent, almost a symmetrical looking asset turnover, because from 2010 to 2012, they saw an increase and it began to start leveling out. And from 2012 to 2013, they saw a small increase. And from 2013 to 2014, they saw a decrease. However, with Disney, they saw a constant increase from 2010 to 2014. And with Paramount, is like a good mix of the two. They remained leveled from 2010 to 2012 and saw an increase from 2012 to 2013 and saw a minor decrease from 2013 to 2014. So now we'll be getting into the profitability ratios, starting off with return on common stockholders' equity, which means it measures profitability of an owner's investment. This is a good measure to see if investors are going to get a good return on their investment. If a company has a negative return, it means that the company is losing money in relation to its assets and as a result, not profitable. And this ratio could be compared with companies that are in the same industry. So as you can see with this graph, none of the numbers are in the negative category. So that means that they're all showing that they're still profitable with their owner's investment. So as you can see with Paramount, seeing the biggest return on their investment or most profit from an owner's investment from 2011 to 2013, they saw a linear increase. And from 2013 to 2014, they saw a big spike going from 0.2 to 0.316. And Disney almost is a linear line, as only from 2012 to 2013, they saw a slightly less increase than they have from the other 4 years. And with Time Warner almost being an inverse of Disney, however, they are not as more linear as from their 2011 to 2012. They increased, but it was more of a leveled out. And from 2012 to 2013, they saw their biggest increase and a minor increase from 2013 to 2014. So now we'll be going over earnings per share, which measures net income earned on each share of common stock. So earnings per share is a good indicator of whether a company is considered profitable or not. It can also be used to value a company and its shares, as well as the growth prospect for the company. And the higher the earnings per share is, the more profitable a company can be. So as you can see, each company year in and year out became more and more profitable. So as an investor, they all look pretty good, but with Paramount, although they started with the lowest, they continuously began to literally increase with their earnings per share and ended up having the highest earnings per share in 2014, with Disney and Time Warner almost being the same at 2014. However, with Time Warner, they saw their big increase from 2012 to 2013, whereas Disney experienced theirs from 2010 to 2012 as a linear progression. There we go. So the next ratio we'll be talking about is the price earnings ratio, which measures the ratio of the market price per share to earnings per share. So the price to earnings ratio is used as an indication whether or not to invest in a company. And low ratios indicates that growth has slowed, but that doesn't necessarily mean that the company is failing. It may mean the company has solidified its market share. And this also tells investors how much a company is worth. So as you can see, Disney in 2010 was the highest out of the three companies. However, they decreased majorly from 2010 to 2014, with ending almost as much as half of what they had in 2010. And Time Warner also decreased, but their fall wasn't as great as Disney's was. And with Paramount, they saw their biggest decrease come in from 2010 to 2011, and sort of almost literally decrease from 2011 to 2014, with seeing a bigger dip from 2013 to 2014. So the next ratio is the payout ratio, which measures the percentage of earnings distributed in the form of cash dividends. So a low payout ratio can signal that a company is reinvesting the bulk of its earnings into expanding operations. A payout ratio over 100% indicates a company is paying out more in dividends than its earnings can support, which some view as an unsustainable practice. There is not a single number for an ideal payout ratio because it depends on the industry the company is in. So I can see with this graph, Time Warner has the highest payout ratio consistently throughout the 5 years. However, they see a decrease from 2010 to 2013 and sort of level out from 2013 to 2014. And with Disney, they see a slight decrease from 2010 to 2011. However, they see a continual increase from 2011 to 2013 with a slight decrease from 2013 to 2014. And Paramount is decreasing from 2010 to 2011 and sees one increase from 2011 to 2012 and continuously decreases from 2012 to 2014. So the next ratio is the profit margin on sales, which measures net income generated by each dollar of sales. So a high net profit margin means that a company is able to effectively control its costs at a price higher than its costs, and investors take it as an overall indicator of profitability performance. A low net profit margin means a company uses an ineffective cost structure. So as you can see, all three companies have a relatively low profit margin on sales, which shows that they use an ineffective cost structure. So as you can see, however, with Paramount, they increase every year from 2011 to 2014, with seeing big spikes in 2010 to 2011 and from 2013 to 2014. And Disney sees a linear progression from 2010 to 2012 and has a leveled out profit margin of sales from 2012 to 2013 and see a slight increase from 2013 to 2014. And Time Warner is almost the same as Disney. However, they literally progress lower than Disney from 2010 to 2012. But then they see a big increase of a linear progression from 2012 to 2014. So the next ratio is the return on assets, which measures overall profitability of assets. So the return on assets show how efficient a company is at making money. A return of assets that increases over time means that a company is doing well at increasing its profits. And a return of assets that's over 5% is considered good, and over 20% is excellent. So as you can see, all three companies continuously increase their return on assets. So they're starting to become better at increasing its profits with their assets. So with Disney, you can see from 2010 to 2012, they progress linearly, with their slowest increase in 2012 to 2013. And with Paramount, they have the biggest jump out of the three companies from 2010 to 2013, and their biggest spike for them in 2013 to 2014. Time Warner is, I would say, more leveled out from 2010 to 2012, with seeing their biggest increase in 2012, 2013. So now we'll be going over the coverage ratios. So with cash debt coverage, it's the ability to see how much a company's operating activities throughout the year can repay total liabilities. So with this ratio, whatever comes out from the cash debt coverage ratio, it means that the company's cash flow is X times greater than its total liabilities. Investors use this ratio to evaluate the company's risk, and creditors, it's also helpful for creditors if they need to know if they're able to pay the money back. So as you can see with this graph, Paramount seems to be the best at repaying their total liabilities, and they just continuously get better over the years. As you can see from 2010 to 2013, they see continual increase, with 2013 to 2014 as a slight increase. But with Disney, however, they remain constant almost with their repaying abilities from 2010 to 2013, but from 2013 to 2014, they experience a major decrease. And Time Warner seems consistent over these 5-year span from 2010 to 2014. So the next ratio is book value per share, which measures the amount each share would receive if the company were liquidated at the amounts reported on the balance sheet. This ratio can be used by investors to gauge whether a stock price is undervalued by comparing it to the company's market value per share. If a company's book value per share is higher than its current stock price, then the stock is considered undervalued. So as you can see with this graph, Time Warner saw an increase from 2010 to 2013 with a major decrease in their book value per share from 2013 to 2014. And once again, Disney and Paramount seem to mirror one another up until 2012, where Disney sees that they are still continuously increasing their book value per share from 2012 to 2014. However, with Paramount, they increase from 2012 to 2013 slower than Disney does. And from 2013 to 2014, they decrease along with Time Warner. So the next ratio is free cash flow, which measures the amount of discretionary cash flow. And the concept that is good to use when evaluating free cash flow is to focus on the trend over time rather than the absolute values of free cash flow. Stability of free cash flow is also important because if it is stable over the last 4 or 5 years, then the stock is less likely to be disrupted in the future. So as you can see with this graph, Disney has the highest amount of free cash flow. However, they're kind of spontaneous and all over the place, as you can see over this 5-year span. Because however, they see a big increase from 2012 to 2013. From 2010 to 2011, they see a decrease, and from 2013 to 2014, they also experienced a decrease. However, and with Time Warner and Paramount, they almost remained stable throughout 2010 to 2012. And from 2012 to 2013, they both experienced minor increases. However, the difference between them is from 2013 to 2014, Time Warner sees a very minor decrease, but with Paramount, they experience a big decrease. And as an investor looking at the free cash flow of these 3 companies, I would say that Time Warner and Paramount are the 2 best options because they're the most leveled out and consistent among this 5-year span, whereas Disney is kind of sporadic and all over the place, and they just can't remain consistent. And the last ratio is debt to assets, which measures the percentage of total assets provided by creditors. So this ratio, it's an indicator of financial leverage or a measure of solvency. And a high debt to assets ratio can mean that a company will have trouble borrowing money, and creditors may become concerned if a company carries a large percentage of debt. So with this graph, they all seem to mirror one another. But with Disney from 2011 to 2013, they see a big decrease with a slight increase from 2013 to 2014. And with Time Warner and Paramount, with Time Warner from 2010 to 2011, they see their biggest increase. However, Paramount from 2010 to 2011 seemed to decrease only slightly. And with Time Warner and Paramount from 2011 to 2013, they seem to be almost mirroring one another. And then from 2013 to 2014, they also seem to mirror one another. However, with Paramount increasing more than Time Warner does. So in conclusion, I would say Time Warner would be the company I would invest in out of these 3 because they're the most consistent with repaying debts and they can pay off their liabilities consistently as well. And they effectively use their assets to generate revenue, with them increasing almost every year. So if I was an investor out of these 3 companies, my best interest would be in Time Warner. And these are my sources that help me with this data. Database research project. Thank you.